This video is going to share a really good insight into stock picking, and we're going to talk about fundamentals versus the meme stocks or the momentum stocks as well as short interest. Now we're going to cover two bear pieces or bears who used to be bears, and we'll see what kind of commentary they have from Bank of America. Now there are two pieces. There's one called BBY Bear, and then there's another one that analyzes the potential trajectory of our market into recession and three potential outcomes. The first that I'd like to start with is BBY Bear. It's actually from last week, but it's worth still covering. And then the other one is just from today. So the other one is super fresh. So we'll get through two of them. One that's a little bit older and one that's super, super fresh. So let's start with this one. This one right here is called BBY Bear. And this used to be a very bearish analyst. And they've just had a change in tone. Let me go ahead and throw up my little banner here for that coupon expiring tonight. There we go. Okay, good. So the new bull market has legs, says this analyst. The bear market is officially over. Now remember, we had a warning from Cameron Cruz over at Bloomberg that just because markets have risen by 20% is not a signal that technically we are out of the woods in terms of potential downside going forward, given that during the dot-com bubble, we had three escapes via a 20% end to the bear market, and we still had downward pain ahead of us. Anyway, we don't put a lot of stock, pun intended, into arbitrary definitions. Okay, good. But note that after crossing the 20% mark from the bottom, the S&P 500 continued to rise over the next 12 months, 92% of the time, versus 75% overall. So just ignore the 2000s era, which would be that 8% of the time. Returning on average 19% versus 9% on average earlier, dating all the way back to the 1950s. So when you basically extract the dot-com bubble, coming out of a bear market with a 20% rally in the S&P 500 is historically more likely to be good than bad. In fact, 92% of the time, the market goes up like 19% more thereafter. That's good. That's bullish. Sentiment, positioning, fundamentals, and supply and demand support that. Being underinvested in stocks and cyclicals is a key risk today. Wow. Savita was always a big bear, and she flipped into now saying, well, the bigger risk today is being underexposed to stocks. This is what I've been talking about for like 9 months, that people are like, Kevin, when are you going to buy crypto? I go, the biggest risk right now is being underexposed to stocks with real fundamentals. Here we are 9 months later and a massive rally later, and now the analysts are finally waking up. Let's go. Okay. The more likely direction of surprise is still positive. We here provide our views on the most asked questions from advisors and clients. Quote or question. Oh, sorry. My short shorts pulled the HDMI cable out. My bad. Or am I wearing short shorts? Maybe I'm naked today. Anyway, what will it take to get investors bullish again? The official end of the bear market might help, but the wall of worry could continue until investors feel pain in long bonds or FOMO. Ooh, that's actually a really interesting argument. This first one here, pain in long bonds. Now that I find interesting. Let's see, pain in long bonds. When are you going to feel pain in long bonds? Well, for you to feel pain in long bonds, you'd really have to see yields go up, because that would make your prices go down for bonds that you're holding. How else could you feel pain? Well, I think you could also feel pain in long bonds by realizing that maybe your bonds are stable. So let's take a look at this. Sure, bonds could feel pain, like price could go down as yields go up, but we don't necessarily think that yields are going to go up. What if yields just stay flat? Well, if yields stay flat, then the value of your bonds stays flat. And if at the same time the stock market is going to do this, I think what she's actually saying is it'd be a combination. Like your long bonds and your portfolio is flat and everybody in stocks is running away. That'd be a little bit of a pisser, eh? But anyway, AI and more below. But a broader bull case for stocks can be made. We are off zero interest rate policies, and real yields are positive again. Volatility and rates around inflation have subsided. No longer afraid of inflation. I'm not afraid. Anyway, estimate dispersion, as in earnings uncertainty has declined, and companies have preserved margins by cutting costs and focusing on efficiency. Even Adobe today revising up their guidance, leading Adobe to actually rally in the pre market here as another software stock set to benefit from artificial intelligence. After a fast hiking cycle, the Fed has latitude to ease. The equity risk premium could fall more from here. Notice she italicized fall. That's because a lot of people are really frustrated that the equity risk premium is already relatively low. People are like, it should be much higher. That's actually an argument that the bears are making. Show shorts, show the shorts, and I'll sub. You'd have to watch my OnlyFans for that. You'd have to pay for that. Come pay $4.99 a month, and you'll get that. Anyway, okay. Which equity index, equal weighted or cap index? Okay, so let's get through a little bit more of this. Quick reminder, because I don't think I've said it yet, and I'm only going to throw the banners up really quick. Yes, we have a price increase tonight. Phase 1 of the price increases happens tonight for the courses on building your wealth. Here are all of those courses. You can just pause there if you want to see them. They're amazing, and we're basically adding a ton more lectures, so we're very excited about those. Okay, now, and the first phase of expiration is tonight, so I'll just leave it there. Okay, so which equity, equal weighted or cap weighted index? So anyway, the equal weighted S&P 500 could yield double the returns of the S&P 500 index based on various signals. This includes breadth, revision, value, blah, blah, blah. They're basically saying today the mega caps like the Apple and Microsoft may have already rallied a lot, and it could be the rest of the S&P 500 that rallies more. Remember, like somewhere around 95% of the gains the S&P 500 has shown this year have been driven by like 7 stocks, like, Tesla and Apple and Microsoft and Google and Facebook. Anyway, if stocks are reviled, why is the S&P trading at 20x forward earnings? Okay, so this is a dangerous, I don't actually know that that's forward earnings. I think that might be trailing earnings. So the dangerous thing about using price to earnings ratios in a recession is that price to earnings ratios are calculated by looking at price. Oh my gosh, imagine this, over earnings. Well, if you look at the last 12 months, what have earnings done? Oh my gosh, they've been in the gutter. And when the number on the bottom gets smaller, the total number gets bigger. Oh, look at that. It's 5th grade math. Yay. So all the, frankly, idiots looking at trailing 12-month PE ratios don't understand simple math. And that's okay. But when you look at forward earnings, the valuations of a lot of stocks are actually still very reasonable. Etsy, Enphase, your Ubiquity. Tesla's starting to get a little rich again, but it still has legs to go. Anyway, so we'll see. How do I invest in AI? Ah, yes. Oh, well, that would be through Kevin's AI course on productivity, where it's not about what tool to use, but it's about mastering how to be productive with AI in your business or as an employee. Anyway, recent developments in generative AI herald a sea change. The obvious beneficiaries are CapEx takers, the ones I just mentioned, and then you have semis and software companies that can provide AI services, but not all tech wins. Many need to spend to remain competitive. The large benefit may be had by old economy, inefficient companies that can increase their earnings power more permanently from the efficiency and productivity gains. That's an interesting argument that maybe, what companies are actually going to be able to deploy the productive AI rather than the software that's maybe providing the AI. I'm very bearish AI software, but I think many of you already know that, mostly because we don't know who the winner is going to be yet. Okay, so here's a chart of various different cycle market bottoms. What will it take to get investors bullish on stocks? We believe we are back in bull territory, which might be part of what it takes to get investors enthusiastic about equities again. This is crazy. Basically, as of a week ago, and in the fund manager survey we just looked at a few days ago, everyone is still under allocated to stocks. And that is great if you are long stocks right now. If investors feel pain in bonds via lower returns or negative opportunity costs, there it is. That's what we explained on the prior page. Real rates rising from here, they should be inclined to return to equities. Right. And then they sell bonds. They actually lower the price of bonds, potentially keeping yields higher. Crazy. Why would real rates rise? A shift from net buying to net selling of the 10-year treasuries. Yep. By foreign buyers or individual holders. Yep. Very, very true. As people move from bonds to cash, you actually drive yields higher. That could mean the stock market could go up as yields go up. That sounds crazy, doesn't it? But anyway, it's possible. Rates, mean revert, lower. Okay, well, it's just some random chart here. Should I index or invest in actively managed funds? We like both, but a choice of index is paramount, more below. We like active investment amid today's signs that this may be the best time for fundamental stock pickers for a host of reasons. Ooh, they're suggesting they like people who look for companies with big PP, big pricing power. Okay, interesting. Reasons why. Resources and eyeballs allocated to active fundamental investing has shifted from passive or private equity, arguing for less efficient market that is basically higher alpha. In other words, in English, like there's an opportunity today to pick stocks that there hasn't been in the past. Okay, good. Then we have, let's see here, mean reversion evaluations, fine. 46% of large cap active funds are ahead year to date, a 5-year high. Assets under management in ETFs is now at a critical mass. Client data shows that the tide may be turning. For most of this year's investors have sold ETFs and bought single stocks. Finally, breadth is indicating a mean reversion for more ETF buying, basically. Wow, interesting. Okay. So what else here? This is about index recap weighted. Okay, here. If equity sentiment is bearish, why then is the S&P 500 doing well? Well, if Wall Street is dominated by buyers, remember the line I said? There are no sellers. Like, who's really selling Tesla? The only reason you'd really sell Tesla right now, because I do think there still are legs, or if you're rebalancing a little bit, or you have to, like some funds have to rebalance a little bit because there are various different compliance rules and laws that say, hey, like if a certain thing has happened, we have to rebalance. Certain sectors can't be too overweight or whatever. But beyond that, like who's really betting against Nvidia right now? As another example, well, it's hard to bet against it. That's why it's only 1% short. But anyway, it's people don't want to sell these things right now because we don't know. But anyway, bonds and cash have been favored over stocks, but there are a lack of sellers. Because there are a lack of sellers, you're seeing more of these price increases. But what happens then when you actually get real inflows into these? Now that'll be quite interesting, and that's roughly what they're prepping for right here. Can I make money off AI? Heck yeah, you can. Obviously, the benefit are companies that provide AI services. We already talked about that, so that's a little redundant. So they give a little bit of some projections over here by 2026. They think the AI total or the AI software market, wow, will represent this item here. And then you've got AI services as a smaller segment, AI hardware as a small segment. Wow, they really see software spend as being the highest. Now, I agree with that. I just don't know which companies are going to be the beneficiaries of that. At this point, it's a little too early to tell. Okay, so you could see here's a bear that's flip flopped, but we have another piece that we have to talk about. Let's look at this one. This one just came out today, actually, and it's called the Bear of Little Brain. Ooh, all right. So what is it? So scores on the doors: crypto 36%, stocks 13%. Well, that's the S&P. It must be, and that must be BTC. What is it? Or I don't know what. Yeah, these are year-to-date returns. Okay, fine. Me, I'm never wrong. Wife, you should explore that. My experience of you is you're always wrong. Biggest picture: cyclical breakouts of non-US stocks versus global fixed income. All right, let's get to where they actually get away from their summary and they get into some actual talk here. Some English is what we want to see. All right, here we go. Ready for this? So first thing I always like doing is I like looking at this bull bear indicator. So right now you've moved off of the extreme bearishness scale, but notice we're actually not at the extreme bullishness side. And this is what I've been talking about, this idea that, yeah, it may feel like, the stock market has been rallying so much, but it's because of a lack of sellers, not because everybody is piling on. So I agree with this chart. And if it were different, obviously, I would say so. I'm not trying to just use this as a way of reiterating my opinion, but I would agree with where this is. I don't think we're extremely bearish right now where people are dumping. But people have stopped dumping, and there's a lack of dumping. There's no dumping happening anymore. That is just any incremental buying is leading to prices going up. So what do we have here? Bears like us have been wrong in the first half of 2023 because, okay, so in other words, bears like us have been wrong. I love that line. It's just music to my ears. But then you have to be careful because as soon as the bears become bulls, does that mean it's time for the bulls to become bears? Oh no. Okay, anyway, Goldilocks trumped recession. Neither the Q1 EPS recession or the first half recession happened. Actually, that would be the second half recession. Nominal GDP remained supercharged by fiscal stimulus. That would be like the CHIPS Act your Inflation Causation Act or Reduction Act, depends on what side of the aisle you are on. Labor market impervious to monetary policy in the post-pandemic world. So far, pretty true. Interesting comparison after the Spanish flu, chart 8. Oh, I want to look at that. I want to see a comparison, chart 8. Here it is. Spanish, no way. Look at that. That's so cool. 1920s. Sorry, this is not the Spanish flu. When was the Spanish flu? Was it 1920? I don't know. Whenever the Spanish flu was. Yeah, it was over here, like 1919 or something like that. Wasn't it? I'm pretty sure it was. But anyway, the 20 Spanish flu era was also impervious to monetary policy. Oh, that's interesting. Let me see what date was this. Yeah, 1920s after the Spanish flu. Okay, chart 8. What are they showing here? Because there's a little bit of a bump here in the U.S. unemployment rate. Let's see here. Let's do this. When was the Spanish flu? Let's find out. So we can February 1918. Okay, yeah, 1918 and 1919. Okay, well, that's what I thought. All right. Well, that's interesting because you did get a little bit of a bump here in the unemployment rate. I suppose maybe not as high as expected. Okay, fascinating. Anyway, no credit crunch. The regional banking crisis threatened a credit crunch, but was averted thanks to the Fed's by the Fed Pivot Facility. It's actually the Bank Term Funding Program, but anyway, no QT, no liquidity drain. Quite the opposite. We basically added money to the markets, which, as we've seen, AI bull run. Unanticipated event in the first half was the AI run, which caused basically this magnificent incline of 7 stocks rising and driving up the S&P. So basically, the bears are like, hey, we weren't wrong because of our opinions were wrong. These crazy things just happened. Like, oh my gosh, we didn't go into a recession and we didn't have an earnings recession. So in other words, you were wrong. There was no credit crunch. And AI is why we were wrong. It's actually a little bit of a cop out, I have to say. Now, this is still bearish right here. We see a max 100 to 150 point upside versus 300 point downside. This is for the S&P 500 between now and Labor Day, which is in September. We are not convinced we are at the start of a brand new shiny bull run. This person sounds salty. We're not convinced we're at the start of a new shiny bull market. This still feels more like a combination of 2000 and 2008, a big rally before a big collapse. But until the Fed reintroduces fear via the terminal rate going to 6% to crack embedded inflation, core CPI around 5%, Treasury yields over 4%, a signal of financial conditions tightening, and then unemployment over 4% signaling a recession, we can still end up having equities elevated. Maybe this could be true, right? I mean, if the Fed does end up wanting to go to 6% and real rates stay high, maybe. But the big thing for me that keeps me bullish right now is that break-evens chart. Now we'll have consumer sentiment data that we'll be paying close attention to, but so far expectations for inflation are staying relatively low and anchored, and that's good. You see a breakout of expectations, that's your sell signal. No landing plays, limited trading upside. Okay, limited trading upsides because the Magnificent Seven have already run so much, is what they're arguing. That's what they're arguing. Okay, cool. So semiconductors say no landing, but PMI says otherwise. Yeah, this is another bear argument people are using. The Purchasers Managers Index, ISMs, which are right here in the negative contractionary territory, while semiconductors are skyrocketing because of AI and chips. Yeah, you are seeing some form of recessionary environment for manufacturing, certainly even freight, and a lot of that makes sense. A lot of companies have spent a lot of money on CapEx and have over allocated, and now there's a limit to how much more they can spend on CapEx, with the exception of AI style CapEx. What do we have here? Consumer savings are only 4.1%. That's true, but if you actually zoom into this, consumer savings have started rising again, and consumers still have excess savings. So yes, while that is bearish, it started actually ironically rising again, which is remarkable. Now, of course, they wouldn't want to show it rising again because it's much better for their argument to go all the way back to, I don't know, 100 years ago. That's all right. Same store sales suggest weakening. Yeah, I do think that staples and store-based consumer discretionaries, the Targets, the Best Buys, and that may have some pain coming. I actually think internet discretionary like the Etsy is undervalued right now, but we'll see. After July, year-over-year comps for inflation get tougher. That's true, but that means we still have one really good report ahead of us potentially. And those are for year-over-year numbers, not month-over-month. Fed credibility on the ropes again? Well, duh. That's why I don't think they're going to start raising rates again because it affects their credibility even more. Magnificent Seven bubble. Magnificent Seven market cap as a percentage of the S&P. This is basically showing you that the biggest stocks in the S&P 500 are the biggest allocation of the S&P 500 again at 28.2% again, compared to the highs of 28.9% in 2021 and the lows of 20.1% in 2022. So outflows from cash in the last 8 weeks, money market outflows. This doesn't look. Here's the 4-week moving average. You actually still have let's see here. Money market flows, positive versus negative. Yeah, okay. First, what do we have here? First outflow from cash in 8 weeks. Okay. So what this is saying is the average flows for money markets right now are still in. That's the dark blue line. That's your 4-week moving average. People are still putting money into money markets. Anytime this number is or the bar is above this line, it's an inflow into money markets. It's going into cash. But we have our first outflow in 8 weeks here again. And I would be surprised if that money is, these outflows we're seeing are going into equities. Wouldn't shock me at all. All right, what else here? Some more charts. You can kind of pause on some of these. Some of these are a little boring. I went through them a little earlier. Bull bear indicator. All right, what do we have here? Hedge fund positioning, neutral. You've got equity flows, very bullish. Equity market breadth, bullish. Bond flows, neutral. Okay, whatever. Bank of America, bull bear indicator. Oh, look at that. See, even though this guy's a bear, you could see that we're not sitting at these euphoric levels of what you saw at the end of 2021. So this is why I still think this rally does have legs. And they just compare winners and losers over here. That's fine. So it's interesting to me. It's sort of a summary of these two things. You have two bears. You have one that flip-flopped away from being a bear and is like, yeah, no, this rally has legs. There are just too many. There's too much money on the sidelines. There are too many marginal buyers still available, and people are hoarding too much cash. Basically, that's on one hand an issue. And then so you have this bear flipping bullish, and then even the bear is kind of like struggling to find an excuse for why they were wrong. But then rather than doubling down on talk of the earnings recession, they're like, well, the Magnificent Seven are overvalued. Oh, well, then is the market bearish right now? No, it's just slightly above bearish, but it's not extremely bullish. So it's like the bear's own arguments aren't really feeding into a reason to be even more bearish here. They do give us a warning that, well, you're going to have higher inflation comps after June, and maybe that earnings recession will come, but he barely mentions that and suggests maybe there's a 300-point downside for the S&P 500 between now and Labor Day. But what's 300 points? 300 points out of where the S&P sits right now is like maybe a 7% downside. And he suggests maybe there's a 2% upside. So I guess we'll have to see. But I personally think the more bearish people end up getting on bonds by an opportunity cost, the more people are going to dump their bonds, ironically keeping yields higher. And then when they keep yields higher, they're just going to drive people into stocks because the value of the bonds will go down. That's why yields go higher, because the value of their bonds goes down. Sure, it's nice to farm that yield, but again, if you're farming 4 or 5%, but then you're seeing stocks do that in a week, it's a little bit of a pisser. So anyway, that gives us a little bit of a look into what the bears are saying. Reminder that we have a price increase tonight on the courses on building your wealth, and we're releasing a lot of new courses, or course lectures rather, not new courses, new course lectures for the existing courses at the end of our 4-phase increase. So buckle up for that. So we have to go to the course member live stream here. I'm just going to look at some comments here. Does the fear and greed index support the change in sentiment? Well, I think what happens, what you could see is you could start seeing an early inflection of a change in sentiment, because what you're doing is you're moving off of the super bearish environment. And that's a change. That's an inflection point, right? So as sentiment changes from everybody's a super bear to okay, less people are becoming bears or staying bears and more people are starting to flip-flop, well, that's an early indicator of you moving away and seeing a sentiment change. It's not saying that everybody is bullish. That's different.